Yeah. Hello, everybody. Welcome to Macro Money. This is Ilya Spivak, head of global macro at tastylive. And we are back for another conversation and another perspective on the macro forces shaping price action and maybe even giving us a lens of what's going to come next here. And a really great day to have this conversation that we're about to have because, of course, the markets are doing something very similar to what we're going to describe, a very defensive day in markets today, and one that seemed to defer to weak macroeconomic data. So what we'll do here is we are going to take a look at earnings, but perhaps with a bit of a different perspective than you might be used to, rather than focus on any given earnings report or anything that might be company specific or even sector specific. We're going to look at what earnings as a whole, as a season, as a narrative might tell us, almost as an economic indicator, almost as a kind of bellwether stage setting tool for where the overall investment climate is, where risk appetite is, what markets seemingly are telling us in their response to what is going to come out here, and hopefully walk away from the conversation with a sense of what is the market default when there is no news, when there is no immediate catalyst. Where is the trend going? What is the overall situation here? And so with that in mind, we are going to first just do a bit of stage setting. So let's consider here initially the way that performance has looked so far. So what we see here is a kind of breakdown of the recovery in risk that we've seen since we've had that conversation at the beginning of October begin to really take hold around the Fed starting to perhaps at least the stage setting for a pivot in policy. So, of course, the Fed still, and we heard this today, talking very much about the need to continue to tighten, the need to continue to keep inflation moving lower and inflation expectations contained. But from about mid-October, the markets have really had a sense that the Fed is starting to see the end of this particular tightening cycle, and that this is becoming increasingly forecastable. So with that, there's, of course, been a bit of a dispersion in performance along the key assets, and some interesting things showing up in that dispersion. So let's take a detailed look. The purple line you see there is the ACWI ETF. That's the All Country World Index from MSCI, and essentially just gives you a sense of the global performance of equities. So not stocks in the U.S. per se, not stocks in any one geography or another, stocks as an asset class. And you can see from the start of that pivot conversation really gaining momentum mid-October. In fact, October the 12th is where the bottom on risk seems to be there, and that's where we've set this up. You see that global stocks have increased by just over 15.5%, 15.6. Notice if we exclude the US from the index, and that's the ACWX ETF, again, that same global index, just pulling the US out of the equation, you can see performance improves dramatically. And you go from 15.6 to 23.6%. So what that's telling you is global shares are growing significantly faster, have been growing significantly faster than the US. You, of course, also see gold has been higher as rates expectations have come in. That makes sense. Gold generally moves inversely of rates because it yields nothing. So when you get a pullback in rates, that makes owning an asset like gold relatively more attractive. And then the US dollar, on the flip side of that coin, that's the UUP ETF there, the Invesco Deutsche Bank US Dollar Index ETF. That's come off down about 9.5%. Then, just to really drive the point home about U.S. underperformance here, we have the SPDR S&P 500 ETF as a perspective on U.S. markets. So we can look at the difference between the global stock index with or without the U.S. and see it. You can really see it when you look at that SPY ETF. So the global average, including the U.S., up 15.6%. The U.S. by itself up just 11.6%. And of course, when you take the U.S. out of the equation completely, 23.6. So a really wide dispersion here, and really showing you that as you get this rates story starting to shift, and that's what the GLD ETF and the UUP one are telling us here, the U.S. seems to be lagging. Now, this is a little bit odd because, of course, one might have expected from looking at the price action over the past, let's call it year, going into the middle of October, perhaps even a little bit more. Any time that you got a whiff of the Fed maybe preparing to offer the markets some kind of a reprieve on rates, you likewise would get a very favorable response from stocks. That is not what you are seeing here. And so I think what you then end up with is, of course, a natural question of saying, well, why is it that U.S. markets are unable to capitalize? Why is it that we have a situation where global shares seem to be doing so much better when the reprieve actually comes? Well, one part of this story may very well be what we got in the U.S. as a function of the tightening cycle. And this is a chart we've seen before, as relative to other geographies and other economies. So take a look here. You see the United States all the way in the top right there, which tells you it's raised rates more than every other major economy. The x-axis of this chart is the change in policy rates over the past year, and you can see the U.S. stands as the winner in that race, 425 basis points added there. The y-axis here is a concurrent move in the exchange rate. So in this case, what we see is the dollar was the best performing currency. And of course, when we look at the dollar as an investable asset in its own right, this rise in rates is a very bullish story, and clearly that's what we're seeing. The dollar added almost 10% last year. When you look at it from the equity market perspective, what this means is that the U.S. saw the largest rise in borrowing costs. Therefore, the most significant and the highest new hurdle to economic activity, and that the dollar's response essentially tells you it is the most onerous to borrow cash in dollar terms at this point. If you're a holder of dollars, of course, higher interest rates mean greater potential lending income. But if you're a borrower, and from the perspective of equity markets, that's the posture we need to take, not as the holders of cash, but as borrowers of cash. Well, then you get into a situation where financing economic activity, even just because of a stronger dollar, becomes that much more restrictive, that much more expensive. And so what you might expect to see is greater pain in the U.S. economy as a consequence of what is an outsized tightening cycle. And indeed, if we take a look at relative performance, we see some of that story. This is, of course, once again, a look at purchasing manager indices. This is where the polling group, most usually in the U.S., it's the ISM, the Institute of Supply Management, the global benchmark now owned by S&P Global, which is what you see here, is market economics. That's market with an I before the T there. And what they do is they go and they ask companies' purchasing managers, so those people that are supposed to make sure that there is inventory and that everything that needs to happen to supply goods 6 months forward, 12 months forward is there. And so these are folks whose job it is to look out and forecast the business cycle. So these people are polled for a kind of more real-time, more actionable perspective on growth. And oftentimes these surveys approximate very well more lagged GDP data, which typically is behind the ball, typically is quarterly. So by the time you see those numbers, which are, of course, the global standard for a sense of economic growth, usually the ship has long since sailed. These PMI numbers give you a more timely look at the business cycle. And what you see here is very interesting in the context of the U.S.'s more vibrant, more dynamic tightening response. And of course, that response follows on from a particularly outsized stimulus effort in the wake of the COVID outbreak just about 3 years ago. The green line you see here is U.S. composite PMI. So this is giving you the pace of either expansion or contraction in U.S. non-farm industry, so services and manufacturing combined. And what you see there is, at the current setting, it is below the 50 line. The 50 line is, in this, which is a diffusion index, the neutral level. So at 50, U.S. manufacturing and service sector industries are neither growing nor shrinking. Above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. And so what you see on the chart there for the most recent numbers in December is the U.S. is contracting faster than other developed economies. So other developed economies also shrinking. You can see the reading there under 50 at 47.1, the U.S. reading at 45. So that outsized tightening seems to be showing the U.S. as underperforming other comparable or similar economies. When we look at emerging markets, they're not doing amazingly well. They appear to be at neutral, but they are certainly not shrinking. And so there seems to be a degree of outperformance there. Now, if we put this in the context of what's happened with monetary policy, it starts to make sense. Developed markets did a lot more stimulating at the onset of COVID from the fiscal side than did emerging markets. They had more money to spend. They had more opportunity to borrow. So it only makes sense. The U.S. was the most vigorous. We've spent close to 9% of 2019 GDP on stimulus, which is World War II level fiscal spending. So, not surprisingly, the U.S. also had the largest jump in relative performance. You can see the peak in that green line stands above everybody else, right around the middle of 2021. That's that outsized impact of particularly aggressive U.S. stimulus. The orange line you can see is next one down. So developed economies spending quite a bit more on stimulus as relative to emerging markets, which don't spend very much, mostly because they don't have it to spend. And then what you end up with is a situation where the red line really sticking much closer to 50 and not having that big spike. Since then, of course, outsized stimulus has generated outsized inflation. And in the US, that has been particularly acute. So not surprisingly, the Fed has clamped down particularly hard. And the consequence now is that US performance is lagging. It's lagging other developed markets. It's lagging emerging markets. And not surprisingly, as we see this pivot from Fed policy, we're also seeing, as the growth consequences multiply, the Fed leading the way toward leaving the tightening cycle. Looking at the performance then of equity ETFs, including the US versus excluding the US, you start to get the sense that in the US, you have a more sluggish growth story in general. And the markets are responding to that and starting to see that economic weakness for what it is. Not just a reason for the Fed to back off and thereby to juice risk sentiment, but rather as the worrying signal for the business cycle, fundamentally, that it seems to imply. Let's take it a step further. When we look at GDP growth expectations in the US, what we very tellingly observe is from October onward, in that very period where risk sentiment was improving, where the markets were, in a sense, narrowly cheering the adjustment at the Fed, how have growth expectations fared? This is a survey of economists done by Bloomberg. And what you see here is November onward, the odds of a U.S. recession within 1 year have increased, not decreased. This is not the kind of situation where you have markets saying, oh, good, the Fed is going to back off. This will usher in another credit-fueled burst of growth, another credit-fueled rise in asset valuations. This is not the message that we're getting from this forecasting. The very period that we're looking at saw the likelihood of a recession rise from about 50-50 to 65 going on 67%. Look at growth expectations. Over that same period, the outlook for GDP growth in 2023, mostly down. The outlook for GDP in 2024, mostly down. What that tells us is that the market looks at this and says, let's not forget why the Fed is backing off. It isn't just to declare victory on inflation, because that victory on inflation comes at a cost, and that cost is growth. So, with that as our context, let's take a look at earnings season expectations. What you see here is EPS growth broken down on average for the S&P 500, so not any one given company, but the index as a whole. And the green part of the chart there on the left are realized results. The orange part there are what is expected for the coming quarters. What you see here is we don't really get a really meaningful pickup in earnings until we get into the fourth quarter reporting season of this year. And that's on current reckoning. But the current reporting season, the one we've just started, the fourth quarter of last year, the expectation is we are going to get a decline of 5.6% on average in S&P 500 companies' earnings. That would be the worst result since the second half of 2020, as the economy really started to grapple with the consequences of COVID, of lockdowns, and of the aggressive decline in economic activity that this implied. So we might very well, as we start to get reports from consumption stalwarts like Procter & Gamble, do tomorrow. As we've gotten some disappointing numbers on the big financial names, Goldman certainly among them. We saw some more earlier today, like PNC. We get into a situation where the market seemingly is getting these signals that the business cycle itself is struggling. And as we get the guidance from these companies that reinforce a sense of gloom, that reinforce the likelihood that the economic environment is going to be difficult for the next year at least, if we look at these expectations for earnings over the coming 3-4 quarters, then you would expect a defensive posture. Now, of course, an important caveat here, one that's perhaps a bit counterintuitive, is that while the S&P 500 index is certainly U.S. based, it is primarily made up, certainly in terms of market cap, share, and weight, of large multinational businesses with exposure to global growth as a whole. The U.S., of course, also is the world's largest economy. And any kind of conversation about the U.S. decoupling in a downturn while the rest of the world grows, all of those kinds of nonsensical notions have hopefully died the last time that this kind of thing was a big narrative in the first half of 2008. We, of course, remember how that all worked out in the second half of 2008 and the subsequent global recession. So as we look at this, it's important to keep in mind this isn't just a story about U.S. companies reporting downbeat earnings. This seems to be a story about a broader global downturn in the business cycle as a consequence of Fed tightening, and indeed as a consequence of the outsized weakness that tightening has wrought in the U.S. Curiously, this might actually suggest that on a relative basis, U.S. equities might be a little bit better positioned now than they were, let's say, over the past month and a half or 2 months, certainly since that turn in mid-October. And this is because if what we're seeing here bears out, and the economic weakness that we're watching is a fear that proves reasonable, then you would see a decline in equities generally, not just in the U.S., but everywhere. There would be a shift away from riskier assets and towards safety. When we do that across asset classes, it typically means weaker equities, weaker commodities, especially when those are cyclically minded commodities like crude oil, copper, natural gas, etc. When we then see the winners in that kind of space, again, across asset classes, we might look at government bonds, we might look at cash. But if we keep ourselves inside the equities space and say, what would a shift from risk and towards safety mean within global equities as an asset class? Well, that would probably imply a move toward liquidity. And nothing is more liquid than U.S. markets. So although equities might be vulnerable to generalized weakness here, what you might see as you've had underperformance from U.S. shares, as we've just described, as a consequence of the outsized and the sooner occurring tightening cycle, so too, as the Fed leads the pivot in the other direction, and as you get more of a risk-off response from markets generally, within the equities space, you might see U.S. names begin to outperform because of a flight to quality, because of a flight to liquidity. We, of course, most acutely see this, and we've described this quite a bit, in the FX space. This is famously referred to as the dollar smile model. Hat tip, of course, as always, to Steve and Jen on that. And what this is showing us is that because of the unique liquidity of the U.S. dollar, because of its outsized role in global commerce, what you see is it does well when U.S. growth diverges from the developed economy average in either direction, up or down. So when the U.S. economy does exceedingly well, as we saw last year, with aggressive rate hikes, you get a positive yield story for the dollar. It outperforms. We may be entering into the left side of the smile here, where when the U.S. significantly underperforms, the flight to liquidity, the flight to quality, and the generalized risk aversion that follows starts to benefit the dollar as a haven. A very similar dynamic might occur within the equity space, where U.S. shares are the U.S. dollar style of foil to global shares and a beneficiary of that flight to quality. Now, of course, that doesn't necessarily suggest that one ought to be going out there buying U.S. shares outright, naked, and betting on them rising while other global shares fall. As we said, looking across asset classes, equities don't look good typically in this kind of an environment. But when you're considering relative considerations and perhaps a pair trade type of setup, you have had a period now of U.S. underperforming global benchmarks. If this risk aversion gains momentum on a relative basis, that dynamic, as with the dollar, might be on the cusp of a reversal. And that is your macro perspective on the earnings season as a whole. As always, thank you very much for joining us here on Macro Money. We are here Monday through Thursday at 4 in Central Time, 5 Eastern, and 2 p.m. Pacific here in newly sunny San Francisco, California. Thank you, everybody, for joining us. We'll see you tomorrow. Godspeed.